Hello traders, this is Blake Morrow with ForexAnalytix and you're listening to the week ahead video for August 1st, 2020. It's actually, it'll be August 2nd by the time that you guys see this, but whatever. It's over the weekend. Hey, I want to welcome you all to this week's installment. Now, before I get started, I have something special for you today, or our team does. We have an interview with myself and Chris Weston from Pepperstone Securities, really to kick off our new partnership with Pepperstone Securities. We have an exclusive relationship with Pepperstone for anybody who's not in the United States and or Canada, and you can figure out how to get ForexAnalytix for free for a certain amount of time if you open a Pepperstone account, a live trading account. So check that out. And then if you're in the US and Canada, we are still partnered up with Forest Park FX, and they will help you find a broker that best suited for you if you're in the United States and or Canada. So make sure you check out our link where it says Forex sponsored. So without further ado, I'm going to bring in Chris Weston from Pepperstone Securities, and we're going to talk a little bit about the markets and how they closed and what to look ahead for. And then I'll come back and give you a quick technical view of how I see the markets. See you in a minute. Enjoy. Well, hey Chris, this is Blake, and I want to welcome you back to the week ahead video. Now, for those of you that don't know Chris Weston is the chief strategist over at Pepperstone Securities. So welcome, Chris.
My pleasure. Thanks for having me on.
So we were talking about the price action at the end of this week, and what do you think stands out the most to you at the end of this week? After a wild move in the dollar.
Yeah, I mean, it's all been one way in the dollar, isn't it? I mean, it's been a tough one for people who are trying to look for that mean reversion trade. It just hasn't happened. And when you get that, there hasn't been much juice in that trade, to be honest. And then the euro dollar, which is obviously the epicenter of this, has continued to march up into 118 and beyond. Aussie dollar into 72 cents. But I think what we're then seeing is it looks like the dollar, well, I said the dollar bears have cut some slack a little bit. I think the easy money's been made in, well, I say easy money, but the money's been made in dollar shorts now. And I think we're probably coming into a period now of uncertainty. I mean, the Fed coined it in the meeting this week, where they said we're coming to a period of extraordinary economic uncertainty. And look, economics hasn't really mattered too much around the world. It's really been about reopenings. You've been blessed. Your currency's been strengthening if your government and your central bank have done more and they've gone above and beyond. It's been about US-China relations, and there's other sort of global macro issues. But now, because the Fed have really put on our radar that we're in this period of economic uncertainty, and that they believe that more fiscal stimulus effectively needs to happen, even if we were to see workers back at work and reopenings continue to happen, more fiscal stimulus happens. And it doesn't, we're not sure whether Congress are actually going to get something together ahead of summer recess. So, yeah, I mean, next week the data rolls in. If you look at the next few weeks going into sort of Jackson Hole and then into the Fed meeting in September, which is going to be a blockbuster, it feels like the data may roll over a little bit in the short term. And therefore, I think the economic data, while it hasn't really mattered too much for price action, is now going to matter a lot more. And that period of uncertainty, in my opinion, sees some sort of downside risks to global equity markets. Credit spreads could widen. The bond market's been big for a long period of time, and I think that's been a story in itself. Yeah. And I think if we do see that equity drawdown, then of course you could see a situation, and that's a big if, of course. But if we do see that, then the dollar may strengthen a little bit, certainly against the emerging market currencies and against the high beta effects such as your antipodeans. But yeah, I mean, if you look at the catalyst out there now, Blake, you're at about 60% of the way through earnings season. We've had the big boys out. That's not going to really, so we're not going to met that catalyst from earnings. You can go into the data. You can go and look at the Citigroup Economic Surprise Index is at all-time highs. So you go ask where the positive shock is going to come through from markets, and there's probably downside risks if data, specifically payrolls next week, comes under expectations. And the central banks around the world have been very dovish for a while now. So you've got to ask, when you're sort of skewing your positive to negative catalyst, they're probably the skew is to the downside, hence why I think we could have a period of drawdown in equity markets before we see a tactical run up into the Fed meeting in September and obviously Jackson Hole as well in late August.
So we've seen this dollar weakness, and it hasn't been obviously against I mean, we've seen dollar weakness against a lot of different currencies, but if the dollar strengthens, do you think it's going to be a one size fits all, or are we going to have to be a little bit more selective in the currencies that we're trading the dollar against?
Yeah, well, that's what we do. I mean, as currency traders, when you're not trading systematic, you're basically looking at your dollar and saying that's one side of the equation. What's the best vehicle and what's the best weapon to express it on the other side of the equation? And really, I mean, it depends on what the sort of macro backdrop, what sort of the thematic that causes the dollar move. Is it just going to be positioning? We saw this morning that the CFTC have said that net shorts in the US dollar at the highest, or the highest net short since 2011.
So right for
We can have a look at
yeah.
yeah, well, we can have a look at the traders for financial futures. I've got a couple of charts if you want to have a look at those. Looking at asset manager holdings of euros at the moment, I don't think they've ever been higher. Leveraged accounts are running a fairly flat position. But if you look at asset managers, which make up obviously a massive portion of the daily flow that you see in euro dollar trades, be it through swaps, be it through spot or forwards or whatever the type of contract is, these guys have never held a longer position in euros. So the question is what's going to push that forward going into that situation? But so I think, when you're looking at the dollar move, is it going to be just repositioning, or is it going to be we see a higher implied vols pick up in global equity markets and also resonating perhaps into rates and FX markets? In which case, if you start seeing equity markets draw down, then you're going to see your MEX, your Brazils, your SAFAs really underperforming, and that's probably the weapon of choice. That if you have that sort of higher risk tolerance, you can go in there. That's where you're going to see the bigger percentage moves. And I think if you want to keep in G10, then of course your sort of risk proxies, Aussie yen, Aussie dollar, Kiwi dollar, especially with the RBNZ coming out fairly soon,
Yeah, it's like
would
next
probably
week,
be your
isn't it?
natural place in G10. Yeah, exactly.
It would be in
So,
2 weeks. 2 weeks. I'm sorry.
Couple of weeks, yeah.
Yeah.
So I mean, if you believe that equity markets are going to draw down, we're going to have a period of higher higher volatility. I think probably the places to do would be short Antipodean, short carry into for the next couple of weeks. But obviously, it's one thing me telling you what could happen. We're talking probabilities, of course, don't we, Blake? And I said that there's an elevated chance. It's when price reacts to that thematic. You've got sort of a fundamental tactical view, and then when price starts to sort of go together, you marry the two together, and you've got a higher probability move, and that's when you're trading. That's when you're putting money to work.
Right. Okay. Well, in our brief conversation just before we started filming this interview, you had a chart that you wanted to show us. Do you want to show to the traders right now?
Yeah, look, we were talking about, and I know it's been a wild sort of topic that's been a lot of people have been focused on for a while now. It's this idea that the bond market's been giving us a pretty dire message for some time. Now, I will say that treasuries are not just a play on inflation expectations. What's happening. With the idea of what's going to happen with growth and central bank policy. You can use treasuries and businesses do use treasuries very liberally to, in repo facilities to, for collateral purposes. You hand down your treasuries, you get hold of short-term cash. So they're still very attractive in that situation. But if I bring up this chart, because one of the obviously the talking points that we can talk about, can you see it now, Blake?
I can, yes.
Yeah, so the idea is that the bond market's been giving us this very dull message, whereas, risk assets such as copper, gold, the equity market, and if you go into the equity market, cyclical defense ratios and, those things have been telling us a factor. So if you look at this chart here, you can see that the blue line represents the US 10-year. I've gone further out the curve, less influenced by central banks. They have less of a hold on the long end of the curve, but you can see the blue line there is the 10-year Treasury. You can see the orange line is the copper gold ratio. So obviously gold's had a really nice move in line with what we've been seeing in real yield.
Yep.
But that's been pretty closely tied to inflation expectations. If we brought break-even rates up, you'd be able to see that copper gold has now started to roll over, but it was moving up in line with inflation expectations. I've got the white line there, which is the 5-month WTI crude futures contract. I've sort of gone away from the first future, the second future, to go further out, sort of turn of the year to have a look more, get rid of all the sort of crazy shenanigans and have more look at the sort of clean structure.
Yeah.
And then, of course, we've got the cyclical versus defensive ratio in the S&P. So cyclicals have really been outperforming defensives. And these are all these various markets over the course of time do have a fairly strong correlation. They do have periods where they diverge a little bit. But you can see now we are in that period of divergence where, The question that we're asking is, are we going to see a period of convergence where all these markets will move back towards the message that the bond market's been portraying? So bonds generally get it right. I think obviously liquidity is one argument that's buoying everything together. But, that message that we're seeing from the bond market is pretty dour. And the question that a lot of people is are these risk assets going to converge to the message that we've been seeing from the bond market?
So the further that we see the bonds move, especially in yields and real yields, the further we see them move, the further lower we see them move, the scarier it becomes for some of these risk proxies. Correct?
Yeah, well, that's it. I mean, I think the equity market's telling us that they expect a cyclical recovery, and we're going to see we're in the midst of like an earnings cycle re-rating.
Yeah.
But I think what's important, again, it goes into my sort of short-term view that the Fed are telling us we're in this period of economic extraordinary economic uncertainty. We're going through a period now. We've got payroll, we've got ISM manufacturing next week. It's going to be better, so that's not really something we're too focused on. It's really, as we go further out, we've got services, ISM, payrolls. The market's looking for about 1.5, 1.6 million net jobs being created, but there are a few fairly clever individuals who are expecting net jobs to be lost. If we were to see that happening, which would be a surprise, then that payrolls number could really set the cat amongst the pigeons. And then those dollar shorts would, it'd be interesting. I think certainly you'd see the dollar rally, which obviously is quite perverse because the data is worse. But you'd like to see, equities under a bit of pressure, and then your Antipodeans and those EM currencies sell off against the dollar. But then put these numbers on your radar, because you go into what I think the 17th of August. You've got the FOMC minutes. Minutes really haven't been too much of an issue for us for a long period of time.
Yep.
But the market wants to explore this change of policy that's going to happen, or this Fed review that they've got, where they're going to change the way that the Fed do business and think about the world. So they're going to move to inflation average targeting, which is a huge, huge change. And it's one of the reasons for me why the dollar's been selling off. The fact that they haven't been able to create inflation, but when they finally do, they're going to allow it to overrun for a long period of time, means that they probably won't raise rates in the US until well past 2025. You and I, Blake, will be old men by that time. So that's the way it is. And so I think that's what the bond market's expecting. They're expecting yield curve control longer term. So we've got those Fed minutes will give us a little bit of lightning whether that's going to happen. And then we go into, as I talk about that situation where we have the Jackson Hole Symposium in Wyoming. That's been the epicenter for many, many years. Ben Bernanke, Janet Yellen. Ben Bernanke on a couple of occasions, pre-announced QE2, Operation Twist, and QE3 at Jackson Hole. Janet Yellen has used it for changes in policy, and I think this is going to be the stage on 27th, 28th of August for Mr. Powell to announce a radical change in the Fed's thinking. And what they'll do is they'll strengthen forward guidance and basically say, until we see inflation over 2% for a period of time, we're not going to raise rates. Or there'll be an unemployment basis where they'll say, until unemployment gets back below 5%, we're not going to raise rates. So they'll give us quantifiable forward guidance by which we can work with. That strengthening of forward guidance is great for bonds. It's great for equities. They love that certainty. It's great for rates. And it continues to be quite bearish for the dollar. So, we've got a few periods of dates which we really need to work with. But if that data starts rolling over, it just leads back into my idea that we could see this tactical drawdown in markets. Currencies will react, and then what we'll probably see is a nice melt back up in risk as we go into that Jackson Hole Symposium. We then see the Congress actually announce what I think is going to be a very positive fiscal stimulus. At the moment, they can't agree on anything, but they will agree on something at some stage ahead of the election. And I think what you'll see then is, a $1.5 trillion fiscal stimulus. You're going to see personal income in the US probably go up about 15% going into sort of September, October, higher than the 10% we saw in April. And that will be the solution for both those monetary policy and fiscal stimulus together to see a nice risk-on rally. I mean, maybe none of this happens at all, but who knows? That's what it feels like tactically in my bones.
And then it takes us right into probably the most highly anticipated election in my lifetime to this point, and probably our lifetime. So Well, Chris, I want to tell you, as and I was talking to the traders that are with ForexAnalytix. The partnership that we have with Pepperstone is great, and one of the things that make it so valuable is having you on the team, and you leading the charge with research with Pepperstone is a real asset, not only to all Pepperstone traders, but also to ForexAnalytix clients as well. So, Chris, thank you so much for your time this weekend, and I'll be looking forward to hearing or seeing your tweets and chatting with you again going into next week.
Yeah, and of course, just on our behalf as well, it's great to partner up with you guys. I mean, I know a lot of our clients read your work and are big fans of what you guys do, and it's great insights as well. So I think it's going to be a great collaboration, and I hope to work really closely with you on putting out some great content as well. So it's great to be partnering up, and on behalf of Pepperstone, it's I hope that we get to sort of share more experiences and give some good insight for clients and prospects there as well.
All right. Well, thank you so much once again, Chris, and have a wonderful rest of your weekend. I'll talk to you this next week.
Thanks, Blake. Take care.
Well, I hope you guys enjoyed that interview with Chris Weston. He is truly a great market professional, and I enjoy his analysis and his outlook on the markets, which we're going to talk about a couple of those things as we go into the technical view of ForexAnalytix. But before I do so, remember, if you have not tried out ForexAnalytix and you just want to give it a whirl, it is $1 for 10 days. So try it out, and it doesn't matter what version you want to use. You can use the premium version, or you can use the light version, or go with either one. But it's only $1, and you'll get to use the premium version. So when you do that, make sure you download the mobile app. Here, let me move the data flash that comes with ForexAnalytix. I'll get rid of that. Make sure you go to the chat room, which is going to be right up here next to your next to the icon with your name. It'll be right over here. So let's talk about this upcoming week that we have. We have some important pieces of data for this next week. It's obviously it's actually the jobs picture for the month of July, excuse me. The important thing that Chris brought up when we were discussing the markets is that data is really going to start to matter, and I think that's important to understand because the markets have been riding high off of expectations, a recovery, the V-shaped recovery, and we've seen it in equities, and we've seen that V-shaped recovery in equities as well. Now from here it gets a little bit more difficult for the markets, especially as we head into the fall season and an election season, and we can really see what the toll has been from the coronavirus on the economy globally and in the U.S. economy. So those things are going to start to matter a little bit more. Now, there's a few things that I want to point out that that we were discussing regarding the dollar. So the dollar, let's talk about the dollar index. First of all, we had a really big bounce on Friday at the end of the week. We have completed the bull flag pattern. You can see that it's clearly finished. The one thing that is true is we broke a multi-year trend line spawning back all the way from 2011, and the thing about the market is we actually still closed the week below that trend line, but I'm not thoroughly convinced that the dollar is ready to reverse just yet, especially if we have a period of risk aversion. August seasonally is not well, let me rephrase what I was just going to say before I even said it. The dollar typically will outperform in August. August is seasonally, it's a good time to be long dollars. So is it possible that the dollar spends a little bit of time recovering some of this lost ground? My opinion is it may. And if I'm just looking at it from a technical perspective, I think there is a risk of the dollar bouncing back to 94.50, maybe even all the way to 96 before reversing again. Now that would be a long long ways to go for the dollar index. If you think about what I'm saying here, the dollar could recover and we could snap back towards, let's say, 94 to 95.50, 94.50, 95.50, 94.50 being the breakdown point here. Whoops, that's not what I wanted to grab. Let me grab this trend line here. Let me just move that back a little bit. Okay, so 94.50 being the breakdown point here, or all the way back to 95.50. And like Chris mentioned, the easy money on the downside with the dollar index has been made. Now, the point that I wanted to make here, and I alluded to it with Chris, is that this is not going to be a one size fits all dollar move, in my opinion. The dollar could move against the euro, but I think it's going to be more aggressive against some of the commodity type of currencies or emerging market currencies. I don't have the chart in front of me right now, but if you look at like the dollar weighted to the dollar indexes we're looking right now, and you compare it to like the dollar versus Latin American currencies or Asian currencies, you're going to see that the dollar, was sold off, but not as aggressively as it did against its European counterparts. So I do believe, and let me kind of rephrase some things that I said, over the course of a couple of weeks ago, that I do think that the euro is going to outperform. I think the euro, there has been enough change in the eurozone that will make the euro a more viable currency to own as an alternative to the US dollar. Does that mean that the euro is going to 120 today or next week? I don't think so. I think the euro is probably going to spend some time backfilling this move, whether it's to 116 or maybe even all the way down to 115 before we, really find some support. But in turn, what you might see is you might see currencies like the Aussie dollar that had this false breakout this week, especially on Friday. You see that reversal. There might be some scope for the Aussie to really correct back down towards 68, 67 cents before making a move. All right. And that's where I think the more aggressive moves are going to be seen is going to be seen against some of these commodity type of currencies, whether you're talking about the Canadian, the Norwegian krona, the New Zealand dollar. Keeping in mind that there's some important data coming out this next week and next week regarding the New Zealand and the Aussie. On Tuesday we have New Zealand employment, which is basically Monday night, and on Monday night, Tuesday morning, we have the RBA rate decision. So those are going to be possible market movers. Then next week we have the RBNZ rate decision as well. So when you're talking about these commodity currencies, they are at risk of making a move. And the Kiwi, just to take a look at the Kiwi dollar, remember we're above a multi-year trend line. This is a multi-year from 2014. We're above that, but couldn't we drop back in the Kiwi back towards 64, 65 cents? My opinion is yes, and maybe we can go even further, because so many people have been squeezed out of their New Zealand dollar shorts. We could actually make our way to the 65 cent level, maybe even further than that, depending on what happens with the RBNZ over the course of the next week and a half, going into next week. Not next week, the week after next. Sorry, it would be the week of the 9th of August. So yes, I do see the scope for a pullback in the euro, the cable too. And by the way, for the pound, we hit the 161% extension of this move lower. You can see this move here, which was in June high to June low. 161% extension, horizontal resistance, rejected it on Friday, and we're pulling back. I could very easily see the cable pulling back towards 129. 128, before bouncing. And so I guess the point I'm trying to make here is don't get too terribly comfortable with dollar shorts down at these levels. I think the risk is that the dollar spends a little bit of time, you know, bouncing, and therefore, if you're short the dollar, you just got to be a little bit more careful. There's one other chart I wanted to bring up. And by the way, gold is still very strong. I think gold is going to consolidate some of these gains while we're above 1900. So just keep that in mind. But I want to take you to the dollar yen, because this was an important chart that Chris and I talked about, not on our interview, but we talked about beforehand, and we totally forgot to mention it. But it's something that I was discussing with some of the guys in my office on Friday. Is if you'll notice the dollar yen, the dips below 104.50. So let me just put a horizontal line here at 104.50, 104.60. Whoops, that's not where I wanted it. That needs to go down here, right? The dips below 104.50, 104.60 have been bought up aggressively in the last several years. I mean, you can go back to 2018. There's 2018. Here's 2019. This is obviously this year in March. We did not spend a lot of time below there. And then on Thursday, Friday, we dipped below that 104.50, and we ripped right back to 106, the breakdown point. That in itself should be a warning to dollar shorts. We could have, the US dollar Japanese yen move back towards the 200-day moving average alongside with some of these non-European currencies. Again, Aussie, Kiwi, Canadian, peso, South African rand, those types of currencies. So guys and gals, remember, and by the way, if you enjoyed the analysis from myself with Chris Weston and you're watching us on YouTube, make sure you click the thumbs up button. That makes us all feel really good that we're putting these together for you each and every week. And if you don't listen to our live webinars, make sure you register to listen to our free webinar, which is the F.A.C.E webinar, each and every morning with myself, Steve Stelios, Dale Pinkert, who does great interviews each and every day, and they're free. So make sure you sign up for those. The link is in the description of this particular video as well. So guys and gals, enjoy the rest of your weekend. I'll see you tomorrow morning on the F.A.C.E webinar. Have a wonderful remainder of your day. Thank you so much for tuning in, and thank you so much for all of your support. My name is Blake Morrow with ForexAnalytix. Talk to you soon.